everyone, welcome to another session. So, in this session, we will be continuing to look at some of the key areas of the advanced performance management paper. So, folks, the next topic that we are going to look at is basically risk and uncertainty. So, what exactly does risk and uncertainty mean? Risk is basically an estimatable, outcome, right? If you think about it, right? However, uncertainty is something that we cannot estimate, or neither can we assign any probabilities to it as well. Okay, folks. So that's the primary difference between these two terms, right? And when it comes to risk and uncertainty, or when it comes to risk more specifically, like what we do is we do assign probabilities to certain outcomes and see like what the overall likelihood and impact of each risk is, right? And this particular process is known as risk management. So when it comes to risk management, how is that done exactly? Risk management is done using the IAPM criteria. What is IAPM criteria? You first of all identify what the risk is that is facing the organization, right? And then you assess the risk. How do you assess the risk? By looking into two things, right? The impact and then likelihood. So by looking into the impact and likelihood, not input, impact, I'll just rewrite this. Yeah. By looking into the impact and likelihood of the risk, we will be able to assess what is the, or whether we should, accept the risk, should we avoid the risk, should we transfer the risk, or should we try to reduce the risk, right? That's what this particular stage is. We assess the overall impact of the risk and the likelihood of that particular risk happening. And then we have P. P stands for planning for the risk. Okay, folks. So that's basically the strategies which we were talking earlier. Okay, folks. Should we avoid the risk? Should we accept it? Like if usually when the likelihood is low and the impact is low, we usually just accept the risk simply, right? Or should we reduce the risk, right, to an acceptable level, or should we transfer the risk to another party? How do we transfer risk exactly? By taking up things like insurance and stuff like that. Okay, folks, that's basically how you do the transfer part. And then finally, we have to monitor, right? We have to, on a regular basis, we have to monitor the level of risks and see if there are any new risks arising, or should we deal with something new, all these things, right? That's basically as to what the risk management process is all about. Now, other than risk management, there are a few tools which we have to learn about when it comes to risk and uncertainty, or to assess risk and uncertainty, right? So what are these tools? Well, first of all, there is something known as scenario planning. And computer simulations. Okay, folks. So by running computer simulations, we would be able to identify different types of outcomes if we make different types of decisions. Okay, folks. So that's one way of assessing the overall, risk and uncertainty that is facing an organization, right? Secondly, we can also conduct a sensitivity analysis. Now, it's kind of similar to scenario planning itself, but the only difference is that when it comes to sensitivity analysis, right, what we do is we look at one key variable and assess the likelihood or assess the sensitivity of that particular variable that could have an impact on the NPV or profits. Okay, folks. So how sensitive is one particular value to have an impact on the profits or NPV is what we are looking at when it comes to sensitivity analysis. If I'm taking an example, let's say that I'm taking, let's say, the labor cost, right? If the labor cost shifts by 50%, okay, folks, if the labor cost increases by 50%, then the profit can become zero. If the material cost increases by 20%, then the profits can become zero. So what are the percentage changes of each key variable that can cause the profit to become zero is what we're analyzing when it comes to sensitivity analysis. Okay, folks, to put it in very simple terms. And of course, we have practiced a lot of questions in relation to this throughout our sessions, right? So remember that, revise through that once again. Okay, folks. So even after the revision, if you can practice, let's say, a few simple questions in relation to certain calculation-based concepts, like let's say, for example, ABC or sensitivity analysis, or maybe maximax, and minimax regret, it would be awesome. Okay, folks. So I would highly suggest that you go ahead and do that as well. And what else? Expected value, right? We can calculate the expected value, which is basically a long-term average, which we use in order to make certain decisions when it comes to to assess the overall best decision in a particular scenario, right? That's basically what expected value is all about. And then what else? There's also, the final point, which is maximin, maximax, and of course minimax regret. Okay, folks, maximin, maximax, and minimax regret criteria is basically another criteria that we use in order to choose between the best outcome, right? So it's all about, all of these tools are just used to assess what is the best outcome, right? That's exactly as to why we use each of these points. Okay, folks, so just remember that. So again, for these kinds of topics, like, there are a lot of calculations involved, I know, right? So it would be really, really beneficial if you can go ahead and do at least some of those calculations, because if you look at maximin, maximax, and minimax regret, right? So this is like one of the easiest topics out there, and still I have seen many students get confused as in, okay, which should be selected and what should be selected, etc. Okay, folks, so just just go through some of the calculations once again, is something that I would highly recommend before going to the exam. So yeah, that's basically some of the tools. And of course, we know that there are risk appetites as well, right? So what are the risk appetites all about? So when it comes to certain organizations or certain individuals, right? So they have different perspectives to risk, right? So there are risk seekers, the people who are willing to take risk, and the people who go for the best of the best outcome, right? And then there are risk averse individuals who does not like taking risks. So what these people do is they look for the low risk or alternatives that can provide them with the maximum return. Okay, folks, again, low risk, low risk outcome, which can provide them with the maximum return, right? That's basically the alternative or the outcome which a risk averse person would choose. Okay, folks, and then finally there's the risk neutral individuals as well. They're like indifferent. Okay, like, if you're getting higher returns, then why not take risk, right? Else, I'm not preferring that kind of people. Okay, folks, so yeah. So if you look at risk seekers, they would usually go for the maximax approach to decision making, right? Because they're always interested in the best of the best outcomes, which is why they're taking this particular role criteria. And the risk averse individuals are more interested in the maximin approach, because they assess the low risk outcomes and choose the best out of them. Okay, folks, because no one wants low returns, right? All of these individuals wants to make huge returns, right? However, the problem is that some of them are willing to take risk and some of them are not. So what a risk averse individual would do is they would choose the minimum, the low risk outcomes, and then choose the best out of it. Simple as that. Okay. And then there is the risk neutral individual who may choose either the minimax regret criteria or maybe an expected values to make their decisions as well. Okay, folks. So that's basically, how the risk appetite works. There can be questions that can come up in the exam to assess maybe the risk appetite of certain individuals. So it is really important that you know about this as well. Okay, folks. So yeah. All right. So that's basically all about, risk and uncertainty. Simple as that. Now, let's move on to another topic, shall we? So the next topic that we can look at is basically big data. I'm writing it big as well. There we go. Okay, so what is big data all about? As the name suggests, it's a huge volume of data which we use for various business purposes, right? This is what big data is, to put it in the most simple sense. And then there comes another term, which is data analytics. So what is data analytics all about? We have a huge volume of data with us, right? So why don't we do something? Why don't we just analyze this particular huge volume of data, identify patterns, identify trends, identify relationships and correlations between different variables, and use it to our advantage. This is the idea behind data analytics. Okay, folks? So we have a huge volume of data, we're just processing it, we're just converting it into information and identifying trends, patterns, correlations, and stuff like that. And we're using that information to various business purposes. We can use it in sales, we can use it in marketing, we can use it in maybe HR, maybe finance, maybe accounting, right? In various business processes. That's basically the overall idea. Okay, folks, so that's what data analytics is all about. Now, when we look at big data, right, there are 4 V's which are mentioned as the characteristics. Some of you may have seen 5 or 6 V's in several other textbooks as well, but majorly as of now there are 4 V's which are fixed. Okay, folks, the others are kind of in discussion to a certain extent as well. So yeah. So what are the 4 V's of big data? My first V is what? Vishnu? No, not really, right? It's basically volume. Okay. My second V is variety. Third V is velocity. And what's the fourth V exactly? Vijay? No, not really. Veracity. Right? Volume, variety, velocity, and veracity. What does this mean exactly? Volume is basically something that we know, which is the huge quantity of the data that we have, right? We have a really huge quantity, right? We know that, and we need, modern computers and processors in order to process all these informations. Simple as that. Okay. Secondly, we have variety, right? So considering the amount of information that we have, it's not just about the volume, but also the variety of the data. Okay, folks, we have data from different sources and of different nature as well, right? That's what variety means. Velocity is the speed at which we can get this data. And as we all know, we can get data at the, milliseconds, I guess, not even seconds, right? Even less than seconds, right? That's basically the idea behind velocity. And then veracity. Now, this is a newly added characteristics, I would say. So veracity is all about the accuracy of the data. Because it's not just about having a huge quantity of data with us, right? That needs to be valid as well, right? So we need to ensure that whatever data that we're using, we need to ensure the accuracy of the data first before using it for any other business purposes. Because if we are using incorrect data, then that can lead to incorrect decisions, which can impact the business negatively. Okay, folks, so that's basically the idea that is mentioned over here. So these are the 4 V's of big data. To put it in very simple sense, I would say. So yeah. And why do we use these big data for exactly? Like, what are the benefits? Do we have any benefits of using these? Obviously, right? Well, that's basically why this is a big topic, right? So what are the benefits? We can conduct maybe something called targeted marketing, right? What is targeted marketing? We've also discussed an example during our session as well, right? So what exactly is targeted marketing? Let's say that you are, searching something on Google. Let's say sports shoes, right? Nike shoes, or maybe Adidas or something like that, right? You're searching those shoes. And later on, when you open a YouTube video, what will happen? There will be YouTube ads, obviously, because we're all lazy to buy a subscription, right? So, there would be ads, right? So obviously, the ads would be more structured to what you have searched, right? If you had searched sports shoes, then the ad would be maybe in relation to that sports shoes which you have searched, right? So this is called search engine optimization, which is a marketing strategy that enables the organizations to target their products to the customers who is seeking that product. Okay, that's basically the overall idea. That's what targeted marketing is all about, right? It helps you It helps a business to identify those customers which are seeking that particular product. That's basically the idea. So targeted marketing, like we can use big data for targeted marketing, and what else? Or to improve the overall marketing process as a whole as well, right? And what else? We can increase customer loyalty, right? Like in modern businesses, they keep a personal information of customers and everything for marketing purposes, to inform them of discounts, season sales and everything, right? So those kinds of things, by providing those kinds of things, we are providing our customers with uh, uh, you know customized services for them, right? So that's basically one way of retaining customers. So customer loyalty can be increased overall. And what else? We will get a competitive advantage, right? Right, we'll get competitive advantage. And what else? Anything else that you can think of? Maybe we can use it to optimize our production efficiency or something like that, right? So, right, operational efficiency. Okay, folks, operational efficiency can be maximized as well with the use of big data, right? So all of these advantages are there, but are there any disadvantages? Most definitely, right? First disadvantage is regarding the validity of the data, not the validity, but accuracy. We have a huge volume of data, but is it accurate is something that we need to look at. And are the sources from which they're extracted, right, are they reliable, right? That's also something that can be questioned as well, right? So that's another one of the disadvantages. And then obviously there would be security issues, right? If, let's say, data is getting hacked or something like that, then personal information of customers and everything will also get hacked as well, right? So there are security concerns like that. And then of course, it requires training as well, right? So another topic that we can look at is basically, 1 second, let me just remove all this. All right, so the next topic that we will be covering would be the methods, or I would say, how do you conduct data analytics. How exactly can you conduct data analytics? Let's talk about that, shall we? So guys, the first and foremost step would be to well, there are 4 steps basically, right? First step is basically descriptive, and then there is diagnostic, predictive, and then prescriptive. Okay, folks. So these are the 4 step-by-step methods through which we conduct data analytics. Okay, folks. So what is step 1? Right? Is basically the first thing that we need to ask, right? So step 1, descriptive, is about what has happened. Okay, folks. So when it comes to the descriptive step, we look at the past, right? We look at things that have already happened. Okay, folks, that's basically the first step, to understand what has already happened. Simple as that. Now, then after that, after understanding that, what we do is we move on to the next step, which is diagnostic, which is why did it happen? Okay, folks. So if something has happened, then what was the root cause of it, right? That's the next thing that we need to understand, right? So if I have to, explain it in that particular way, the first 2 steps basically focus on the past, whereas the other 2 steps focus on the future. Okay, folks. So this is basically the idea, isn't it? So descriptive and diagnostic is about what has happened in the past and why did it happen exactly, right? But after you understand that, what is the next step? You would be predicting things, right? So predictive analysis. So what will happen? What will happen? So over here, what we do is we assess the current information that we have, right? And predict what can happen in the future. Okay, folks, so that's basically as to what predictive analytics is all about. Okay, simple as that. And then finally, we have prescriptive, right? Prescriptive is all about how will we deal with it. As in, what is the, or in other words, what course of action needs to be taken. Okay, folks, so this is what we do in prescriptive analysis. So in descriptive, what has happened? Diagnostic, why did it happen? Prescriptive, what will happen? And then, predictive, what will happen? And then prescriptive, how will we deal with it? Or what kind of course of action can we take against that particular thing? Because if we are predicting something and if we are able to identify some sort of a threat or something that can happen in the future, then we will have to take a strategy on how we will deal with it, right? And the same can be said for opportunities as well, right? If you see an opportunity in the future, let's say that as of now in the current market, AI, machine learning, and all these stuff is booming as of now, right? So how exactly can we make use of it is something that businesses would be thinking, right? So that's what prescriptive is all about. Okay, folks, so simple as that. So this is how you need to implement data analytics in your business. First of all, gather the historical information, read through it, and then understand why exactly did each and every significant event or something like that happened. And then you use the current information that is available and predict the future, what can happen in the future. And then you decide, okay, what kind of course of action can I take against it? Okay, folks, so this is how you can conduct a data analytics. Simple as that. Right? So that's it. That's basically all about this particular topic. And of course, there are many other methods of analytics as well, right? Alternative methods, I would say. Some of them include, we can do something like text analytics, right? So as the name suggests, like we will be reading through text, right? Or the softwares or systems and everything, right? They go through texts and everything, and then they assess what is the overall, let's say overall like they create an overall summary regarding what the idea is all about. Okay, folks, so that's basically the idea. I'll give you an example here. Let's say, for example, if let's say that I want to understand a particular review of a restaurant, right? As to whether a particular restaurant is good or bad. So what I can do is I can maybe search that particular restaurant on Google Maps, right? And then maybe go to the comment section and read through the text, right? If I have a software to do all of this for me, then that's all the more great, right? That's what text analytics is all about. And then there would be image analytics. I mean, if I can analyze text, then why not images, right? Right? So, there are softwares that are available as of now, which can, like, for example, Google Lens, right? You can use Google Lens to, scan through your areas and maybe search, whatever you want to search, right? As to what a particular object is. If you scan it on a leaf, like what kind of leaf it is, right? All those things, right? That's basically the idea. And then there is sentimental analytics. What is sentimental analytics all about? Well, basically, it's the idea that like what are people's emotions behind certain comments and stuff like that, right? That's basically what we're trying to analyze. Okay, folks, simple as that. And something similar is voice analytics, right? Analyze certain voices, let's say for my lectures or something like that, and then provide, let's say, subtitles or something like that. Those kinds of softwares can be used, said to be an example of this. Okay, so yeah, that's basically it. So these are some alternative analytics that can be used for various different business purposes. Okay, folks, so simple as that. So yeah, that's basically all about big data and data analytics. That was kind of interesting, isn't it? So there are a few other terminologies which we have to learn about, such as AI. What is AI? Artificial intelligence. Okay, folks. So what is artificial intelligence all about? Well, that's the biggest question that there is, right, as of now, at the very least. So artificial intelligence is basically a software or a program, uh, you know that basically captures input, processes it, and then learns from it eventually. Okay, folks, so that's basically as to what artificial intelligence would do at the moment. Of course, people are going to think about, let's say, Jarvis from Iron Man, or many other softwares from many other Hollywood movies, but that's just an exaggerated. Maybe that's the end result that we're aiming for, but overall, as of now, it is a software that can capture input, learn from it, and do different tasks as output. Okay, folks, so that's basically the idea. Okay, as to what an artificial intelligence is at the moment. And machine learning is like a subset of this particular term of artificial intelligence itself. And then there's also robotics, which is dealing with hardwares which can be used to perform different tasks, right? Like creating robotic arms or something like that. Robotic, like you would have seen some robotic creatures and stuff like that in several videos and stuff like that, right? So that's basically the idea. Okay, folks, so yeah, so artificial intelligence is more into the programming aspect, whereas robotics is more like making it or giving it a physical form. Okay, folks, by using hardwares. That's basically the idea. All right, so that's basically as to what all these technological topics are all about. Now let's have a look at another topic, shall we? So the next topic that we will be looking at is basically in relation to information systems. Okay, folks, so let me write it down for you. Information system. So when it comes to information system, we've learned about several types, right? But first of all, what is an information system? An information system is basically the set of hardwares and softwares that we have in a particular organization to meet the data requirements of the business. Okay, folks, so that's what an information system is all about. Now, there are several types of information systems that they could have. There is, first of all, the TPS, or the transaction processing systems. Okay, folks, so like, for example, the barcode scanners that you see within within supermarkets, right? So all those things are considered to be a TPS system. But what does that particular system do? It scans the barcode, right? Enters the product and quantity details and everything into the system, right? And eventually the bill is processed, right? So that's basically the idea. It records the transactions. Okay, folks, it stores the transactions, and it we can later on retrieve that transaction as well. So any system that records transactions, that basically comes under this particular category. And secondly, we have the management information system as well, or MIS, right? Management information system. Now, management information system is a system that is there to help the managers plan certain things, schedule certain things, right? And make decisions eventually as well, right? But one key aspects that you have to remember about management information system is that it primarily uses internal information or information within the organization. Okay, folks, so that's basically one really important point that you have to remember about regarding MIS, or management information system. And then we also have EIS, which is executive information system, right? So over executive information system, it uses both internal as well as external information. So if we look at MIS, it's primarily used by tactical managers, isn't it? Or manager at the middle level of the organization, right? Such as departmental heads and people like that. But EIS is primarily used by the executive level, or the strategic level managers. Okay, folks, the CEOs, the CFOs, right, and all those board members and everyone. And why is that? Because at the strategic level, it's not just about having internal information about the company, but we also need to have awareness of, we need to have some external information, such as the how is the market going, what is our market share, what is the market size, right? What is the competition level? How is the business environment, right? All these information is also needed. And for that purpose, we have executive information system. And what else? There's another system, that is DSS, decision support system. As the name suggests, it helps to make decisions by providing the managers with sufficient level of information so that they can make a good informed decision. What is an informed decision? Let's say, for example, you're choosing your optional papers, right? You chose APM, and you're maybe choosing AAA or AFM for that matter, right? You just simply choose by tossing a coin or something like that. Well, you can't toss a coin because there's only two sides there, but still, right? So do you randomly choose these topics? No, not really, right? You research into each of these papers and then understand what the content is, what the scope is, what field it relates to, and then choose the papers accordingly, right? So you do your research, gather information, and make an informed decision there, right? So that's what an informed decision is, okay, folks? And DSS can help the executive management to make an informed decision by providing them with the right information at the right time. Simple as that. And finally, we also have the ERPS system. Now, this could be, tested in the exam as well. So, enterprise resource planning systems. Now, this is basically one single integrated system, okay, folks? So, it's just a single integrated software that integrates the activities of the organization. Okay, folks, so that's basically actually what this is. One single software that can manage everything, right? So, for example, like in the field of accounting, we have accounting softwares like Oracle, SAP, what else, Sage 50, right, or Tally. Like there are many other softwares like that, right? QuickBooks, etc., right? So, all of these, softwares, like, what's the idea here? So, let's say that in accounting, there are step-by-step processes which we do, right? First of all, we record transactions through journals, and then they classify it to ledgers, and then a trial balance is prepared to check the financial accuracy, and then we prepare the financial statements, right? However, what if we had a software to do all this? Like instead of hiring different people to do all these processes one by one, why don't we just buy a software so that can integrate all of these aspects, right? This is what a particular ERPS system does. Okay, folks, it integrates or coordinates activities, and can get us information in a really quick basis. Okay, folks, so that's basically the overall idea here. So yeah, that's what ERPS systems are all about. Now there are several other ERPS systems. It's not just about accounting, but even in HR and stuff like that, we have a lot of softwares available. So raising that point as well. So yeah, that's basically it. And I wouldn't say this is a part of an information system, but there's another really important concept that we have to learn about as well, which is CRMS. Okay, folks, customer relationship management systems. Now, this particular system is like very popular among modern businesses because nowadays customer focus has really increased, isn't it? People are more or businesses have been researching on how to add more value to customers, right, through their products and services, right, which is where CRM comes into being. Okay, folks, so CRM can help an organization to manage customer relationship by providing customers with customized services, or we can help retain customers, right, increase customer loyalties and stuff like that, right, and handle customer complaints or anything like that as well. Okay, folks, so that's what this particular system is for, to put it very simply. So yeah, that's basically it. That's basically as to what these are. And other than this, there's also another technological topic, I would say, which is really very, very relevant to the exam. And these are some of the technological developments. Okay, folks, few terms which you have to learn about. First of all, there is the RFID tags. Okay, folks, what are RFID tags? Like you may have when shopping to some malls or something, right? So every inventory or every product within that particular textiles or shopping mall would be tagged with an RFID. Why is that? Because an RFID tag can help indicate the location of that particular product. Okay, folks, so that's basically through radio frequency. Okay, folks, so that's basically the idea here, right? So that kind of technologies can help track assets. Like if it's a really huge organization and we're unable to identify where a particular asset is, then you can use RFID tags to track them. Okay, folks, so that's basically the idea here. So that's basically what a radio frequency identification tag is. That's the full form. Okay, folks, radio frequency identification tag. So yeah, RFIDs. And then another technology would be the network technologies. right? Kind of straightforward, right? It's a connection of computers, but primarily we use internets and intranets, right? What is the difference between an internet and intranet? Internet is, as we know, it's a public network, right, across the globe, world wide web, right? That's basically as to what that particular network is. And what about intranet? Intranet is basically a private network that they have in some organizations. Okay, folks, so that's what it is. Simple as that. To put it very simply, in simple terms. And then we also have cloud technology as well. So what's the idea behind cloud technology? Basically, Google Drive, right? Google Drive, OneDrive, there are many other, softwares that are there, which can be used as an example, right? So that's what, cloud technology is all about. Like, you can store all of the data within a particular, uh, space, virtual space, that is outside our storage system or outside our mobile devices, outside our computer systems, laptops, etc. Okay, folks, so that's basically as to what cloud technology is all about. Okay, folks, so you can upload anything to the cloud, which is so your data is safe online within a cloud storage, right? And you can access it from any devices that you wish through, of course, security credentials and stuff like that. Okay, folks, so that's basically the idea here. So easily accessibility and safe storage is basically the primary aspect when it comes to cloud technology. Of course, there are security concerns at times, right? Because we don't know, like, it's a third party software, right? So we're not exactly aware as to like as to where some as to whether someone can hack into that particular system or steal the data, etc., right? So that particular issue is still there, but again, it's still quite a useful and handy software that most businesses use these days. And what else? We also have knowledge management system. So what exactly is a knowledge management system all about? When it comes to knowledge management system, it's all about the knowledge that people have within the organization. Okay, folks. So each individual which we hire will have a particular professional skill or many soft skills and hard skills for that particular matter as well, right? So all of these skills combines, right? The knowledge of the people within that organization, okay, folks, is basically, if you look at it in another way, it's gonna be a database, right? If you think about it, right? Every individuals that we have within a particular organization, they hold some sort of knowledge about how to do things, the efficiencies, the right way of doing certain things, right? So it's all about managing this particular knowledge, and it's not just about managing the existing knowledge, but it's also about teaching them or increasing their capacity of knowledge by providing them with trainings and stuff like that as well. Okay, folks, so that's what knowledge management systems are all about. Okay, folks, it's just a public library kind of thing that most businesses have regarding certain resources, certain knowledge about how they do things in that organization, like, or their methodologies and all these things. That's basically the idea here. And then finally, we also have unified corporate database. Now, I'm sure that when you have practice questions, you would have seen this particular concept in multiple questions as well, right? So it's a really important concept. What is a unified corporate database? Instead of each systems and laptops keeping their storage within that particular device itself, why don't we have a unified virtual space where we can store everything? Cloud technology, yes, it's something similar itself, right? So that's basically the idea. Anyone in the organization who has the authorization, of course, they can access that particular virtual space and make changes to the files and everything. Okay, folks. So rather than having the same file in different computer systems, let's just have it in one virtual space. That's basically the idea behind a unified corporate database. And it helps to tackle the issue of data silos. What is data silos exactly? Data silos happens when you have multiple versions of the same file stored in your computer systems. Okay, folks. So that's basically the idea. The problem with that is that, first of all, there is duplication, and we don't know what the updated version is, right? So that's basically the idea. Okay, folks. So yeah, and of course there is the Internet of Things, which is another technology. What does Internet of Things means? Basically, it's the idea that yeah, it's basically when all the devices and all the let's say smart devices, I would say, are interconnected with each other through some softwares and applications. Okay, folks. So that's what Internet of Things is all about. To put it in very simple terms. Okay, folks. So that's basically the idea. IoT, we call it IoT as well. Uh, and then there is also process automation, which is another aspect. What is process automation? Automating manual processes to make it more efficient. Okay, folks. So see, and this is a common question that most students had in relation to automation as well as artificial intelligence as well. Like will we lose our jobs or something like that, right? So that's basically the idea here. So guys, the primary focus of certain businesses nowadays is to implement these for one particular reason. Okay, folks. So every organization has these core activities as well as non-core activities. And the idea for these organizations is to automate the non-core activities, as in those activities which doesn't really add value, or those activities which are not exactly the organization's actual business model, right? So for those small activities or inefficiencies and stuff like that, we automate processes. Okay, folks. So, however, for the core activities, that's something that we still have to do ourselves. So this is the primary mindset that businesses have at the moment. Okay, folks. So they identify. It depends on different businesses as to what core and non-core activities are. Okay, folks. For example, if I take let's say any business organization for that matter. Let's say one of the big four firms, right? Their core activities of any big four firm, be it Deloitte, be it EY, their core activity is to provide professional services, right? This is their core activity. Yes. However, there would be certain non-core activities that they have as well, right? For example, running a cafeteria for the employees, right? Or hiring security guards and stuff like that to protect the assets, right? These are the non-core activities. It is essential, yes, but it's not contributing to the core activities as such, right? Or the business's vision as such, right? So therefore, what these people do is they outsource these non-core activities, such as cafeteria or securities and stuff like that. Okay, folks. So the same thing, like for if you look at the work, let's say that I'm conducting an audit, right? I would have to, let's say, you know, uh, verify the financial statements, assess the risk. I'll have to identify issues here and there, test controls, right? These are all my core activities when it comes to an audit, right? However, what if I consider a process like converting a PDF into an Excel, right? Converting PDF into an Excel. Is that a core activity? No, not really, right? It's just a clerical work that I need to do. I need to do it because I can't do any other processes unless I convert a PDF into Excel, right? So, which is why we have some automated softwares and stuff like that to convert a huge amount of PDFs and stuff like that to Excel, format things properly, and do some activities that does not really add value to our time. Okay, folks. So that's basically the idea, right? So that's what core and non-core activities are, and that's where we implement automation. Okay, folks. Automation is implemented on non-core activities, to put it very simply. So yeah, that's basically, these are basically some of the technological developments that has occurred over the year, and that's currently trending, I would say, as well. So yeah, moving on to another topic, shall we? So now let's talk about strategic performance measurement. Strategic performance measurement. So how exactly do we conduct performance measurements? Well, first of all, there is the go-to method, right, which is ratio analysis, right? This is something that we do. Remember all the ratios, guys. Okay, folks. So and of course, if you know any other ratios on your own of your own, then you can definitely use that in the exam to conduct, let's say, financial performance analysis or something like that, if needed, if required. Okay, folks. So yeah, what all ratios do we know? We know gross profit ratio, net profit ratio, that's the go-to ratios, right? Profitability ratios. And then current ratios and quick ratios. And then there's ROCE, ROI and RI, right? And then there's EVA is something that we also learned as well, right? And what else? Other than these basic ratios like gearing ratios like debt to equity or interest cover ratios and stuff like that, right? There are many other ways in which we measure or assess performance, okay folks. So there's also the net present value, right? What is the net present value all about? It's basically the net net of cash inflows and outflows, or net present value of the cash inflows and outflows of a particular project, right? To put it very simply. And how do we interpret it? Interpretation is really important, isn't it? So how do we interpret NPV? If it's a positive NPV, yes, it's contributing to the shareholders' wealth. If it's a negative NPV, it's not contributing to the shareholders' wealth, right? This is basically how we assess it. So ideally, we should be taking projects with a positive NPV, right? And what else? Other than the net present value, we also learned about internal rate of return, or IRR, right, as we call it, right? So what is IRR? Well, IRR is basically the cost of capital, right? It is the cost of capital at which my NPV would be zero, right? So ideally, my NPV should be positive, right? So IRR can be seen as a threshold. Okay, folks. So anything above IRR is something that we need to accept, and anything below IRR is something we should not accept, right? That's basically the overall idea. Oh, yeah, my bad. So I'll just write it down for you over here as well. If my cost of capital is greater than IRR, should we accept it? What do you guys think? Should we accept this particular project if the, wait 1 second. Yeah. So if my cost of capital is greater than IRR, should I accept it? No. Okay, folks, you should not, right? Ideally, my cost of capital should be less than IRR. Because if it is greater than IRR, that would mean that I'll be getting a negative NPV. And if it's let's say less than IRR, then there will be a positive NPV. Okay, folks. So that's basically the idea. That's how we interpret or use this particular measure. And what else? Of course, IRR has one particular disadvantage, which is that IRR assumes that we are reinvesting the cash flows to achieve the IRR itself, right? As in, it assumes that let's say that I'm getting some sort of returns from a particular project, right? So I'm investing it again at IRR to make zero NPV, right? So that doesn't make sense, right? Because ideally, if I, let's say, invest something and I get returns out of it, then I should be investing it, I should be reinvesting it to make more money, right? Not to get a zero NPV, right? So that's exactly why we have a modified IRR. Okay, folks, modified IRR uses the equation n root of terminal value divided by investment. We've done many calculations throughout our sessions, right? So remember those and do some of those simple calculations which we've discussed, okay folks, once again, so that this particular concept is very thorough, because there's comparatively less questions in relation to MIR are available, but it's still a relevant topic, okay folks, so remember that. So yeah, modified IRR assumes, like, changes this assumption, okay folks. So IRR assumes that we reinvest money to get zero NPV again, whereas modified IRR assumes that, hey, we'll make more money if we reinvest, okay folks. So that's basically the only change here, to put it very simply. And of course, there is the economic value added, which is the other aspect. And now this is a really, really important measure, right? So I'm just gonna, write it separately as well. Economic value added. So what is the equation, guys, for economic value added? NOPAT minus adjusted capital employed at the beginning of the year. Okay, folks. So always use the capital employed at the beginning of the year. Okay, folks. At the start, multiplied by WACC, right? Multiplied by the weighted average cost of capital. This is the equation, isn't it? And there are some basic adjustments that you need to know. For example, how do we get NOPAT exactly? NOPAT is basically, first of all, we take out the controllable net profit or operating profit, right? I'll just write the operating profit. Right? I take the controllable operating profit, right? And what all things do I add back exactly? I need to add back my accounting depreciation, right? Accounting depreciation is something that I add back to the controllable profit. And what else? If there is an increase, there's an increase in provision, then that needs to be added back as well, right? And if there is any non-cash expenses, such as amortization, for example, right? That needs to be added back. And what else? Advertising expenses, and then R&D or training costs, right? All of these things will be added back to my controllable operating profit. Okay, folks. Now, what all things would be deducted? Let's talk about that. I should be deducting, again, it's the opposite to what I've explained earlier, right? Instead of accounting profits needs to be added back, and economic depreciation would be deducted. And then what else? If there's a decrease in provision, that would be deducted, right? And then amortization for R&D, for advertisement will be deducted as well, right? And then there's one more adjustment, which is tax paid. Tax paid, okay, folks, not the tax liability. Be mindful of that, right? Tax paid plus tax relief on interest. For the interest payment, there will be a tax relief, right? So that's also, netted off with tax paid. Okay, folks, so remember that as well. So these are the deductions that will be made as part of calculating NOPAT. Okay, folks, so once you make all those additions and subtractions, you'll get NOPAT as the figure. Okay, folks, so remember these adjustments because that could come in really handy when it comes to the exam. Okay, folks, so yeah. All right, and of course, like we've gone through all of the advantages as well as disadvantages of economic value added, right? What is the greatest advantage of economic value added? It's in direct correlation with the objective of maximizing shareholders' wealth, right? So that's like one of the key advantages when it comes to EVA, right? We mentioned that. And then what are the disadvantages? The disadvantages would include things like VAT, right? VAT is kind of difficult to calculate, and VAT includes a lot of assumptions as well, right? So that's something to be be mindful of, right? And again, EVA, since it's a new measure, it might be difficult for certain managers to comprehend. So we may have to provide them with sufficient amount of training and understanding of how this particular measure works and what all adjustments are there. And of course, economic value added as an advantage to it, there would be it's more closer to the cash base or cash flows, right? So rather, because we're deducting all the non-cash expenses, right? So that's basically why it is a calculation of the value that we're adding. Okay, folks. So that's basically the idea. So yeah, that's basically it. And we've discussed many other advantages and disadvantages for all of the other aspects as well. For NPV, for modified internal rate of return, for normal internal rate of return as well. So go through all that, guys. It's really important. That can help you really make really good relevant points when it comes to the exam. Okay, folks, so go through that once again, I would say, and yeah, then we'll be good to go, right? Now, moving on to another aspect, another measure, I would say, quite an easy one, right? We have ROI and then RI. Return on investment and return on, sorry, and then there is residual income as well, right? So what is return on investment? What is the equation here? PBIT divided by capital employed, right? Profit before interest and tax divided by the capital employed times 100, of course, to convert it into a percentage. Remember, guys, this is a percentage figure, whereas residual value is an absolute figure, right? And what exactly is the, why exactly is that relevant here? Because it enables comparison, whereas for residual value, comparison is difficult. Why is it difficult exactly? Why is comparison of residual income really difficult? Well, that's basically because, due to the difference in size of organization or division. See, we usually do comparisons in between divisions or with another organization, right? So it's kind of difficult to compare residual values due to the size differences of the divisions as well as companies. Okay, folks, so that's basically the idea mentioned over here. So since ROI is a percentage figure, it can definitely enable comparisons. Okay, folks. So, but since RI is an absolute value, comparison may not be appropriate. Same point for we have the same point for economic value added as well. That's also an absolute figure, isn't it? So therefore, comparison may not be appropriate. So that's quite a relevant point, right? And is there any disadvantage of ROI? Most definitely yes. Okay, folks. The most crucial disadvantage that you have to remember for the exam is that ROI does not promote investments. Why is that? Because if I make an investment, then my capital employed will increase, right? And if my capital employed increases, what happens to my ROI? It decreases, right? So that's basically why managers will not be motivated to make investments, if their performance is measured based on ROI. Okay, folks, so just keep that particular point in mind, right? It's a really important point, and you can use it in any instances if ROI is tested anywhere. Okay, folks, so remember that. All right, so that's all about that, and now moving on to another topic. So now let's talk about transfer pricing. Now I know this is a really difficult topic for most students, right? So I'll just quickly cover this as well. So let's assume that there are two divisions, division A and then division B. Okay, division A is selling some goods to division B internally within the organization, and so my A would be the seller, and then B would be the buyer, right? So how do I determine the transfer price, or the price at which this particular goods should be sold exactly? So guys, there's a threshold, okay, folks. There's a minimum and maximum limit, right? And my minimum limit, what is my minimum limit? Or what should be the minimum transfer price exactly? The minimum transfer price would be the seller's marginal cost plus opportunity cost of transfer. Okay, folks, seller's marginal cost plus opportunity cost of transfer. This should be my minimum transfer price. Why do I say that? Because of course the seller needs to look at their variable costs and everything, right? And fixed cost, that can be apportioned to some of the other products which they are probably selling, right? And if there is any opportunity cost, for example, if they are, by selling it to B, if they are sacrificing, let's say, revenue which would have been received by selling externally, then that can be considered to be an opportunity cost, right? So that particular amount can also be added to the transfer price. So this will be my minimum limit, right? And then there is the maximum, right? What is the maximum limit? What is the maximum transfer price that can be there? Maximum transfer price would be the lowest price at which the buyer can buy it externally, right? The lowest price at which the buyer can buy it externally. And of course, if there is any, yeah, uh, if there's any internal savings, right? By selling internally, then that will be deducted as well. Okay, folks? So the lowest price at which the buyer can, so if let's say B is buying the product, right? Then in the external market, what is the lowest price at which B can buy this particular product for? That should be considered. Plus, if A is making, see, by selling externally, you don't have to pack that particular product or something like that, right? So those packaging costs or delivery costs and stuff like that can be saved, right? So those cost savings should be deducted from the price as well, is what these points would be. Okay, folks. So these both of these individuals would be negotiating with each other. A would say that, hey, the minimum price that I can sell my particular product for would be my marginal cost plus any opportunity cost which is there. And B would say that, hey, I can only buy this particular product for the lowest price, lowest market price, or like if you are making some cost savings by selling it to be externally, then that needs to be deducted as well. Okay, folks. So because we're not going to be paying for unnecessary packaging or delivery costs since we're in the same organizations, right? So that's basically the idea. Okay, folks. That's basically how a transfer price is determined in very simple terms. And there are many different ways or many different approaches to determine the transfer price. It could be standard price plus standard cost plus pricing, or it could be either full cost or marginal cost plus pricing, right? Or there could be we can just go by the market price itself, right? That's another alternative. And then so these are basically the approaches, right, to determine the market price. So determine the transfer price. So that's basically it. That's basically the idea. But these are general rules in determining the minimum and maximum limit. So remember that, and everything should be good, right? So simple as that. And when it comes to a not-for-profit organization, what is a not-for-profit organization? A not-for-profit organization has a purely non-financial objective, most probably, right? Because their primary objective is not profit maximization or increasing shareholders' wealth. It would be something of a philanthropic nature or of a social welfare kind of thing, right? That's basically the idea behind a not-for-profit organization. Do they have shares or dividends? No. Do they have profits? No, not really. Instead, they have surplus and deficit. So what is surplus and deficit? Surplus is when the income that they're receiving is greater than their expenditure, whereas deficit is the opposite, when expenditure is greater than income. Now, but the primary point here is, how do we measure the performance of a not-for-profit organization? Because there is no financial ratios that we can use, right? And even if we do use it, it won't be of much benefit either, right? So that can't be done. And this is where the value for money principle comes in, right? Value for money. Basically the 3 E's. What are the 3 E's? Economy, efficiency, and then effectiveness, right? These are the three E's of value for money. What does each of these mean? Economy means obtaining the inputs at the most lowest cost possible without compromising the quality. Okay, folks? And then efficiency is getting the maximum output from the minimum inputs, right? That or from the available inputs, right? And then effectiveness is basically there are some targets which we set even for not-for-profit organizations, like it's the achievement of those targets as well. For example, for a hospital, I may set a target of total number of patients to be treated in a particular month or a year, right? So like has that particular target been met is what we're just measuring through effectiveness, to put it very simply. Okay, folks, that's what the three E's of economy is all. Sorry, three E's of value for money is all about. So it's really important to apply these principles, because at times you may be required to suggest measures and apply the three E's in certain scenarios as well. Okay, folks. So be mindful of this. Understand what each of these are, right? And then there is for not-for-profit organizations as well. There's another concept known as league tables as well. So what is a league table exactly? For profit-making organizations, they have benchmarking, right? And league table is kind of like benchmarking itself, but for not-for-profit organization. Okay, folks. So the idea behind league tables is that, like, let's take universities as an example. Okay, folks. So if I'm applying for a particular degree or something in a university, then what I would do is I would look at the league table to see the university rankings, right? So the ranking of each organization, not-for-profit or public sector organization, would be given, and we go by that, isn't it? That's basically as to what it is. It's a simple rank list. That's just it. Okay, folks. There are some advantages and disadvantages to it as well, right? Because the advantage being that individuals can, as in the normal people, can understand the level of performance of this particular organization. For example, if I'm a student, let's say, I will be able to identify which university is better than the other, right? That's basically something that's there. And then, like the taxpayer is happy, right? Basically, like, public sector, the taxpayer would be happy, obviously. And then, again, we would be able to compare performance of different organizations based on certain measures and standards, right? That's basically another really good advantage. Disadvantage includes things like, there would be dysfunctional behavior. For example, the people within that organization would much rather be focused on making the measures in the league table better than achieving the organizational objectives. Okay, folks. So that's basically another disadvantage that would be there. Okay, folks. And other than dysfunctional behavior, it is quite judgmental to rank certain organizations. Plus, more and about that, like what kind of measures should there be for a particular industry or market, right? That's something that needs to be determined, right? And it's kind of difficult to determine, and it's quite subjective as well, right? And of course, like if everyone is not using standardized measures, then comparison won't be possible, right? So that's it. Okay, folks. So these are some of the advantages and disadvantages of league tables. Go through this once again, guys. It's really important. Like if it is tested, then advantages and disadvantages can give you some points that you can make in a particular scenario. Okay, folks. So yeah. All right. Then let's move on to another one, shall we? Another topic that we could think of would be the problems of using only financial measures. Okay, folks. So what are the problems of only using financial measures? Well, I'll tell you the first problem. There would be tunnel vision, right? Tunnel vision in the sense like, you're only focusing on one aspect of the business, which is making the money part, right? But what about all the others? Like, are we understanding the bigger picture of the business? No, not really. So folks, I can, have a look at the revenue growth and say that, hey, my product is getting popular, right? However, like, how can I increase it? How can I increase the revenue in the future? Will I get any insights from just looking at the financial information? No, not really, right? So to understand the bigger picture, we will have to look at the non-financial aspects as well. And what else? What else can be there? Lack of focus on quality. If the quality of my products and services is not good, then obviously the organization won't survive long, right? So we may make profit for maybe another year or so, but after that, it's gonna start declining, right? That's basically the idea. And then what else? Any other points? There could be, uh, yeah. Okay. So cause of success may not be known. Okay, folks, we won't be able to, identify what exactly caused the success factor. If revenue is increasing, what is causing the revenue to increase? We're not looking into that, right? So that's basically the only, that's basically another issue by only focusing on the financial aspects. And of course, these are all historical information, right? Historical information, and therefore it's not forward looking, is what we're trying to say. Okay, folks, it's all historical information, and no, there's no forward looking information as such. These are some of the problems of only focusing on non-financial measures. So it kind of gives us a bigger understanding as to why we should be using financial measures as well, right? Sorry, non-financial measures as well, right? Because non-financial measures can give you the bigger picture, right? Can give you the bigger picture about the organization, that where you're lacking, like, how can you add more value to the customers, why are customers dissatisfied, right? All these things can be assessed, and there would be a focus on quality when it comes to non-financial measures, right? And then we will be able to know about the cost of success as well. That's kind of obvious, right? And then it's forward looking as well, right? Non-financial measures would be forward looking as well, because it gives us future insights as to what needs to be done to improve our performance. Okay, folks, so simple as that. So it's prescriptive rather than descriptive, if you remember the data analytics part, right? That's basically the idea. Okay, folks. And what else? And of course, it is kind of easy to use as well, non-financial information. But again, there are some disadvantages, not disadvantages, I would say. I would call them challenges more than disadvantages. Okay, folks. Challenges would include the subjectivity. Okay, folks, for things like, let's say, customer ratings, or for things like quality related aspects, like we cannot quantify everything, right? There are still some information which is like really difficult to quantify, right? So that's one of the challenges when it comes to measuring non-financial information. And then gathering non-financial information may involve certain degree of costs and stuff like that as well. Okay, folks, so these are some of the challenges as well. So just remember that, those points as well, because that can come in handy in the exam. All right, if that's the case, let's have a look at another topic, shall we? Quality management systems. So when it comes to quality management systems, we look at four concepts. Okay, folks. First of all, we look at Kaizen costing, and then there would be target costing, which we already discussed, right? TQM approach, and then JIT. Okay, what is Kaizen costing all about? It's basically, it's the idea of continuous improvement through small incremental steps. Okay, folks, that's what Kaizen costing is all about. So you can, let's say, save costs and stuff like that, but on in small baby steps. That's basically the idea, and there should always be improvement. Okay, folks, that's one of the key conditions of Kaizen costing. So remember that. It's just a Japanese concept. Target costing is something that we've already looked at, so I'm not going to waste your time, going through it again. So TQM, what is TQM? Having a zero defect policy, right? Zero defect policy. That's what TQM is all about. It's all about getting it right the first time, right? That's basically as to what the TQM approach is. And then we have JIT, which is basically a demand pull system, right? As in, we manufacture our products or inventory as and when the order comes in. That's basically as to what the just in time is all about. And, there are some key features of just in time, as in, first of all, you need to have good supplier relationships. You need to have suppliers who can get you the goods at the right time, right? Without any delays and stuff. And then you need skilled workers, skilled labor is necessary. And then and of course, remember guys, there's no inventory. Okay folks, inventory is bad when it comes to a JIT environment. And then all the machinery should be maintained appropriately, because if there are breakdowns, then that can cause inefficiencies and delays in delivering orders, customer orders. Okay folks, so yeah. So yeah, these are basically the concepts of quality management systems. These are different strategies that we can implement in order to maximize the quality to a certain extent. Okay folks, is what we're trying to say. All right, makes sense as to what these are. And then when it comes to quality, there are some quality related costs which we should learn about as well, right? Yeah. So quality related costs, there would be conformance costs, and then non-conformance costs as well. Conformance cost includes preventive costs, and then appraisal costs, right? This is what conformance costs are. And then non-conformance cost includes, again, two types, right? Internal failure and then external failure. So let's talk about conformance cost first of all. What is preventative cost? These are those costs that are there to prevent an issue or defect from happening in quality wise, right? That's basically as to what preventative costs are. Appraisal costs are those costs which are things like appointing someone to inspect our goods to look for defects or manufacturing defects and stuff like that. Okay folks, so that's what appraisal costs are all about, to put it very simply. And then when it comes to non-conformance cost, we have internal and external failure cost. Internal failure is when the product is damaged within the firm before selling it to the customer. Whereas external failure cost is basically when the customer raises a complaint that, hey, the product that you sold us is defective. Okay, folks, that's what external failure costs are. So there is a cost involved in reworking on these defective products or scrapping them, etc. Right? That's basically as to what these costs involve. And ideally, I should be investing more or spending more conformance costs so that there is no non-conformance costs happening. Okay, folks, that's basically the overall concept behind quality related costs. To put it very simply, of course. Of course, we're putting everything simply, right? As in, we don't want any complexities just before the exam, right? So yeah. All right. What else? Then we can discuss about the concept of lean manufacturing. Okay, folks, what is lean exactly? Lean is waste or non-value adding activities. Okay, folks, and ideally within my manufacturing process, I should be eliminating all the lean or wasteful activities that there are, right? So that's exactly what lean manufacturing is all about. There are several ways to do it. One of them being Six Sigma approach, using the Six Sigma approach. What is the Six Sigma approach all about? DMAIC, right? We have to first of all define the problem, right? Define the problem. What exactly is the issue that we are facing? And then you'll have to, measure. I'll just write it down like this. Yeah. Define, measure, analyze, improve, and then control. Okay, folks. So within a particular manufacturing process or any other process for that particular matter, we have to first of all define what the particular issue is or what the customer requirements are. Okay, folks, right? Understand what that is, and then what can we do? We can assign measures to measure the extent to which we have met most of these customer requirements and stuff like that, right? After that, you have to conduct an analysis as to whether the measures are appropriate, right? Analyze the existing process and see whether all the measures, all the processes are being conducted appropriately, and then we can look for improvements. Okay, folks. After we define, measure, and analyze, what do we have to do? We have to look for ways in which we can improve the existing processes within the business. Okay, folks. And finally, once the improvements are implemented, we can monitor as to whether it is creating efficiencies or not, right? That's basically something that we do. So this is what Six Sigma approach is all about, DMAIC, to put it very simply. Okay, folks. Now, there's also another concept or another way in which we can ensure, wasteful activities are eliminated, and it's basically using the 5S concept. Okay, folks, 5S concept. So there are 5 S's is what we are saying. What are these 5 S's? First of all, we can structurize, right? We can structurize our office layout or something like that so that there's smooth movement of information of people, etc., right? And we can systemize certain processes and stuff like that so that everything is done in a very systematic manner without any inefficiencies, right? And then we can sanitize. What does sanitizing mean? Avoid clutter. Okay, folks, as in, we should avoid unnecessary information or irrelevant information from gathering too much, or it depends on the process as to what you're trying to sanitize, but it's all about removing the wasteful activities or non-relevant or irrelevant items. Okay, folks, so that's basically as to what sanitize mean here. Not putting on a sanitizer or anything. Standardize. What does standardize means? You can standardize the processes within an organization. Okay, folks. So it's basically having a set process for certain activities. Okay, folks. That's basically it. A predetermined set of processes for certain processes. That's basically the idea. Okay, folks. So that's what standardization mean here. And then there's self-discipline as well, which is really difficult, right? So what is self-discipline all about? It's all about, self-discipline is all about sustaining the other S's. Okay, folks, it's all about sustaining the other S's. That's what self-discipline is all about. Ensure that the structure is appropriate throughout, right? Ensure that the systematic processes are being conducted systematically. Ensure that we are avoiding all the clutters and it's not keep forming again and again. And then ensure that all the standardized processes which we have predetermined is being followed by the employees. Okay, folks, so this is what self-discipline is all about. Kind of like control. Okay, folks, so that's just it. That's basically the 5S concept, to put it very simply. Again, that's basically all about this one. And this as well. Now, another aspect which we can look at would be the Hopwood management styles. There are 3 styles basically, right? There is the budget constraint style. There is the profit conscious style, and then there is the non-accounting style as well. Okay, folks, so what's the idea behind each of these? Budget constraint style involves like following a target based approach, right? There are targets set and we just follow them accordingly. Simple as that. Okay, folks. But what about profit conscious style? What about profit conscious style? So here, the overall performance is measured based on making profits, right? As in, is everything, every activities that we're doing eventually leading to an increase in profit. That's basically as to how that particular style operates in. And yeah, and of course, but the thing is that even though we are focused on profits, like we're talking about long term profits here, okay folks, not just short term. Okay folks, now if you're following, let's say, a budget constraint style, then obviously there would be a lack of focus on the long term, right? Because we're just achieving targets, that's just it, and targets are usually short term itself. But if you're using a profit conscious style, right, then of course everything would be we would be focusing on profits. However, for the long term profits, okay, folks, so that's basically the idea. And then there's the non accounting style as well. What's the idea here? So when it comes to non accounting style, like we're saying that hey, like these budgets and all these aspects are not that relevant. Let's just focus on the non financial aspects, the quality, the customer satisfaction, right? And all these things. Okay, folks. So that's what this third style is all about. To put it very simply. So these are basically the simple Hopwood management styles. Now, what else? What else can we discuss? I guess now the only thing that's left over would be those, frameworks or models, right? As in, the first model that we will be, looking at would be the balance scorecard. So, what is the balance scorecard approach? The balance scorecard approach looks at four perspectives, right? What are the four perspectives? First of all, there is the customer perspective, right? How exactly are we adding value to the customer, right? This is basically something that we look at. And then, there is the internal business process perspective, right? We look at internally within our business processes and see whether everything is being done in the most efficient manner or not, right? That's basically the aspect. And then there's the financial perspective, right? Kind of obvious, right? We look at the financial aspects. And finally, we have learning and innovation perspective. Okay, folks, like, are we innovating within our business? Are we growing by learning more, right? That's basically as to what we look at over here. So one of the key advantages of using a balanced scorecard approach is that we will be able to look at the organization from each of these four perspectives, which focus on the financial as well as the non-financial aspects, along with internal and external information as well, right? So when conducting performance measurement, let's just implement the balanced scorecard approach and ensure that we have all the KPIs from all four of these perspectives to ensure that we're focusing on the internal and external aspects as well as the financial and non-financial aspects as well. This is what the balanced scorecard approach is all about, to put it in very simple terms. Now, the next aspect that we will be looking at would be Fitzgerald and Moon's building block model. So what does the building block model have to do here? So there are three aspects when it comes to a building block model, and remember one key point, guys. The balanced scorecard approach can be applied primarily, they apply it primarily to manufacturing businesses, but it's a generic model just like that. But when it comes to Fitzgerald and Moon's building block model, this is primarily in relation to service businesses. Okay, folks, you implement Fitzgerald and Moon primarily in service businesses, so be mindful of that. And there are three building blocks, right? What are the three building blocks? There is dimension. Let me just reduce the size here. There we go. Yeah. Dimensions of performance. Then there is standards. and then there are rewards as well. Okay, folks, what are the dimensions of performance? Profit, quality, flexibility, competitiveness, and resource utilization. Isn't it? These are the five dimensions of performance. Profit, as we know, like it's all about maximizing the profit of that particular business overall. And then quality needs to be focused, because especially when it comes to a service business, quality is a very important aspect, right? How people how the service provider is interacting with the customers, like are they able to provide services depending on the customer's needs, right? How's the overall layout and everything of that particular business? All these things are really important, right? Flexibility, like are the people within that particular business able to provide services according to the needs of the customers, or depending on the changing demands of the customers, is what we're talking about flexibility here. And then competitiveness, right? How competitive is the business, and like are we keeping track of the competitors? Are we performing better than them? All these things. And of course, resource utilization, are we using all the resources for that particular businesses appropriately? Simple as that, right? So these are the dimensions of performance. And when it comes to standards, what's the idea? Standards should be three things, right? OAE. Ownership, first of all, right? The people who are following the standards should feel like they can own the targets, right? That's basically the idea here. Okay, folks, so that's basically as to what ownership is. And then achievability is for achievability, as in the standards should be achievable. You shouldn't set the bar too high, because people will be demotivated, right? And E is equity. Okay, folks, like the standards should be set in a fair manner. Okay, folks, so that's what equity means. And then we have rewards. Rewards includes MCC, motivation, as in reward should obviously motivate the individuals who are working in that particular business. There should be clarity. It should be clearly communicated to the individuals as to how they can perform well and achieve more, get more rewards. Okay, folks, so that's basically the aspects over here. And then controllability. Okay, folks, just the principle of controllability, right? We should not hold people responsible for things that are outside their control. So rewards should only be set on those aspects which the individual has a control over, is what we're trying to say here. Okay, folks, so these are the three dimensions of the Fitzgerald and Moon's building block model, right? And you may have to apply this in certain scenarios, so just be mindful of that. Okay, folks, so yeah, remember guys, it's primarily for service businesses. Okay, folks, so yeah. And of course, another really important topic would be, I'll just draw it out for you, and I guess you'll be guessing it based on that, right? So okay, we have 1, 2. There you have it. So what is this all about exactly? Performance pyramid, right? That's basically as to what it is, right? First of all, we will have the corporate vision at the top, right? And below that, we have items that supports the two items that supports the corporate vision. What are those? There's the market, and then the financial aspects. Okay, folks, there's the market as well as the financial aspects as well. And then below that, we have three items which supports the market and financial aspects, which is, first of all, there is flexibility. Is the company able to meet customers demands and needs according to their changing tastes and preferences? That's basically as to what flexibility is all about. And then there's customer satisfaction, right? And thirdly, there is productivity as well. Okay, folks, and below this we have 4 aspects. What are these 4 aspects? Quality, delivery, cycle times, and then waste. Okay, folks, and as we all know, objectives go down the pyramid, whereas measures go up the pyramid. Okay, folks, this is how the uh, basically the performance pyramid looks like, right? So we have the operational activities at the below stage, right, which is quality and delivery, and then there's cycle times and waste, right? We start by setting objectives from above, right, from the corporate vision, right? So there would be a corporate vision, and there would be two sub objectives, which is one in relation to the market and the other related to finance related aspects. So for market related aspects, we further down have customer satisfaction and flexibility. Whereas for the financial aspects, again, flexibility is also there, but primarily there is productivity as well. How do we maximize productivity? By reducing the cycle times and reducing the wastages. That's basically how we can maximize productivity, right? And flexibility is, again, maximized through delivery and cycle times as well, like delivering products on time to meet customer demands and stuff like that, right? And then customer satisfaction is, again, maximized by quality and delivery as well, right? Right, because if we provide the quality goods to the customers at the right time, or if it is delivered on time, then obviously they will be satisfied as well, right? This is how you read the performance pyramid. Okay, folks, and most of the time performance pyramid will be given to you in the exam as well. You just have to apply it to the scenario. Okay, folks, so yeah, be mindful of that. All right, so that's what the performance pyramid is all about. What else? Well, the only thing that's left over would be VBM and ABM, right? So let's talk about VBM first of all. Okay, so VBM involves having a mindset of value addition, right? How can we add value to the organization? It's all about having that particular mindset itself. So how do we ensure that the people within my organization is adding value exactly? Well, I basically implement these step by step processes, right? Step one would be to develop a strategy, right? Develop a strategy to achieve my corporate objective, right? Course of action, basically, right? Step two would be to set performance target. Step three would be to create an operational plan. And then step four would be to measure performance. Okay, folks, so these are the four steps which I can use to implement a VBM in my organization, or implement that mindset of having value addition in my organization. Okay, folks, so first of all, I'll have to develop a course of action to achieve my corporate objectives, right? And then I'll set targets for those particular course of actions, right? And this is then communicated to the employees, and then appropriate rewards and stuff like that will be set so that employees are more motivated to add more value to the shareholders' wealth, right? And then finally, we measure the performance and see if there is any gaps or something like that, and try to improve the processes once more, right? This is basically what happens, or this is basically how you can implement the value-based mindset within an organization. Okay, folks, that's what value-based management is all about. And finally, we also have another concept, which is ABM, right? Activity-based management. So when it comes to ABM, there are two types, right? There is operational ABM, and then there is strategic ABM. So what's the difference between these two? I'll just write it down for you as well. Operational ABM focuses on efficiency. Okay, folks, it focuses on efficiency. What about strategic ABM? It focuses on customer. And of course, the long-term aspects. Okay, folks, that's basically the difference between these two. As in, operational APM focuses on incorporating efficiencies at the operational level and throughout the organization as well, right? The more efficient we are, the better, right? And strategic APM is all about, how can we add more value to our customers? Okay, folks, that's the mindset that there is for strategic APM. Okay, folks, simple as that. And of course, because if we are able to satisfy our customers, or if we are able to add more value from our customers, who are the primary source of revenue, right? Revenue increases, profit increases, dividend increases, and then share price also increases down the line, right? That's basically the idea. Okay, folks, that's what the overall concept of ABM is all about, to put it in very simple terms. So yeah, that's basically it. Okay, folks, so that's basically all about this particular topic as well. Again, in the exam, you will have to implement these in several scenarios, and a few exam related tips, guys. As in, when it comes to the exam, it's all about two things. Okay, folks, first of all, you have to structurize your answer, right? Like we discussed throughout our sessions, right? We talked about a lot of exam techniques. We talked about a lot of ways in which we can structure our answer to score more marks, right? So do that. And more and about that, you have to use the scenario information. Okay, folks, use the scenario information as much as possible, because marks are not obtained just by writing the theoretical knowledge that you know, right? It's more about using these, understanding the business model of the scenario that is given, and talking from all the informations that is provided to you within the scenario itself. Okay, folks, so go through the scenario carefully, read it once, read it in depth carefully, and then use the information, plan your answer, and then start writing. Okay, folks, so that's basically something that I would highly suggest for your upcoming exam. So we've gone through the entire syllabus of APM, at least the key topics of the APM syllabus, and now I hope that you are ready for your exam. So I wish you all the very best for your upcoming exam, and hope to see you again in another session where we will learn something new. Okay, folks, so till then, this is Vishnu Jay signing off.